In this video, we'll talk about the importance of specialty-specific disability insurance and walk through some of the key features that most doctors should consider having on their disability insurance policy. Hope you enjoy and find it insightful.
What is disability insurance? It's income replacement insurance. If you were to become disabled for an extended period of time and you were not able to work or do the job you were trained to do, if you have a disability insurance policy, you would get a continuous paycheck. That would help you pay your bills and provide for your family. Now, what sort of disability is covered, or what's the definition of disability? Most people think of disabled as they were in some sort of an accident and they lost the use of their arms or strained their back or did something along that lines. But oftentimes the disability is caused by a disorder or a disease that prevents the individual from doing the work they were trained to do or doing their job.
Own occupation disability coverage protects a physician not just based on their ability to work as a doctor or to work and earn an income in general, but based on their ability to practice in their chosen specialty and earn the income commensurate with the training they've gone through to get to that stage of their career. If you're asked to work as a lab tech, which I would argue many physicians are well qualified to do based on their expertise, that's not going to earn you anything like the same income. Just the same, if you're an orthopedic surgeon and you're asked to work as a hospitalist because you can no longer operate, that is a very troubling position to be in. So it's important that your disability insurance policy is occupation specific down to the level of your medical specialty.
The cost of disability insurance has a pretty large range. I've seen policies as low as $20 to $30 a month and policies well over $1,000 a month. It really depends on the age of the person, the occupation, and most importantly, how much benefit and riders are going to be attached with the policy. A general rule of thumb for the cost of a disability policy is usually around 1% to 2% of your gross annual income, post-training income. And the idea there is you're going to give up 1% to 2% of your income to protect the other 98 to 99%. It is beneficial if you're still in training, residents and fellows. It's very common for there to be large discount programs available for you guys if you can get that base policy secured before you finish up training.
A disability insurance policy could either be non-cancelable and guaranteed renewable or guaranteed renewable. When an insurance policy is both non-cancelable and guaranteed renewable, that means that the insurance company is not allowed to change any of the plan provisions, such as the definition of disability, any of the features or riders on the policy, or the cost, as long as you continue to pay that premium. In a policy that is just guaranteed renewable, the insurance company is not able to change any of the plan provisions, but they could potentially change the cost.
Let's distinguish benefit period from wait period. The benefit period is a length of time that you can potentially be on claim. A common benefit period is to age 65, although you can extend that to age 67 or age 70 if you want to pay a bit more in monthly premium. The wait period is the amount of time that you have to wait before you can go on claim once you get disabled. A common wait period is 90 days or 180 days. And if you want to wait a little bit longer, you can save on monthly premium.
The inflation rider, also known as the cost of living adjustment rider, COLA. This one is important if you want your benefit amount to increase over time to account for cost of living increases. For example, over a 30-year span, cost of living is going to double, so you might want your disability insurance benefit to double over that span as well if you're permanently disabled. Now, every company has some slightly different options for this. Some offer a 3% increase per year, others offer one that is tied to the consumer price index up to 6% per year. Some companies offer simple interest on their 3% rider. Others offer compound interest. Compound is going to generate a larger benefit over time, whereas simple interest will not increase quite as much. It'll only be 3% off of the original benefit amount. So, over a long period of time, that can make a difference. So really, this rider is probably most important for younger people. If you're still in your 20s or 30s, maybe early 40s, and looking at getting a policy, because if you are permanently disabled over a 20 or 30 year span, that claim could really add up with inflation adjustments.
Hey guys, I'm going to be talking to you about the residual or partial disability insurance rider. And effectively what this does is it protects against partial disabilities where due to an injury or sickness, you're unable to perform one or more of your job duties and you have a loss of income because of that. So with most companies, if you have a loss of income of at least 15 or 20% or more, and you're unable to perform one or more of your job duties, you're considered partially disabled and a partial benefit will pay out. And what it is, it's proportionate to the percentage of your income lost. So for example, if you have a 50% loss of income or duties because of a disability or sickness, they will then pay you 50% of whatever your monthly benefit is at that time. So whatever the percentage of your income lost, that's how much monthly benefit you'll receive due to that partial or residual disability. The more you know.
Future increase option, future purchase option, benefit update, benefit purchase rider. Different companies call it different things, but this feature allows you to increase your monthly disability benefit to protect your higher income as your income rises throughout your career, without answering health questions or proving you're insurable again, which is huge, because this allows you to protect that higher income regardless of any changes in health that occur. Some companies let you exercise this option annually. Other companies, it's once every 3 years. Generally, the one every 3 year companies, it's a use it or lose it feature. So it's really important to be aware of what the terms are with your policy and make sure that you're exercising it if needed to maintain that feature on the policy.
If you're looking for a way to create a more robust disability insurance policy, catastrophic benefit riders might be appropriate for you. What catastrophic rider benefits do is pay you an additional tax-free monthly benefit on top of your normal monthly benefit that you typically receive in most traditional senses of disability. Now, as the name implies, it's fairly difficult to qualify for them given that you have to be catastrophically injured to a point where you're unable to perform 2 out of 6 activities of daily living. And those could be feeding yourself, bathing yourself, walking around alone, many different things categorized under that terminology. You can look it up. But given that there's fewer circumstances where that benefit will pay out, typically catastrophic benefits will be pennies on the dollar when compared to your traditional disability insurance payouts. So again, if you're looking at creating a more robust coverage that can help protect you and the family long term, definitely something that we recommend looking into.
Let's talk about the student loan repayment rider. This feature reimburses you for student loan payments made while you are disabled. It has a maximum benefit, such as $2,000 per month of reimbursement, and a maximum benefit period, like 10 to 15 years. These amounts usually depend on your student loan balance when you apply for coverage. With most companies, this feature does not cost much, so it can be a good way to obtain quite a bit more protection while you still have your student loans. And you can then remove this rider from your policy when your student loans are gone.
Mental health and substance abuse claims are interesting ones for disability companies to handle. Many companies will pay out claims due to disabilities related to mental health and substance abuse. However, most companies will limit benefits paid for those types of claims to 2 years. Now, there are a few companies that will offer unlimited benefits paid for those types of claims, but not all companies. And even the ones who do offer unlimited, there are some restrictions. Certain specialties such as anesthesiology and emergency medicine are often limited to 2 years regardless, just due to the increased prevalence of claims for those types of conditions for those specialties.
One question that I often get from clients is, what company should I go through to get my disability insurance? The answer to that question is almost always, it depends. Our favorite answer to a lot of questions. Because what makes sense for you is not necessarily what makes sense for everyone that you went to medical school with. There are 6 companies that offer policies with true own occupation coverage. We're comfortable with the quality of coverage provided by all these companies, so we usually start by trying to figure out which will be the most cost-effective for you. That depends on 4 main things. 1, your gender. 2, your specialty. 3, your age. And 4, the state you live in. It's never that simple though. There are a few differences between policies that may matter to you. So when you're looking into coverage, make sure whoever you're working with is getting to know you and looking at multiple companies to determine which is the best fit.
For more information on disability insurance, we encourage you to read some of our blog posts, listen to the Owen Occupation Disability Insurance episode of our Financial Clarity for Doctors podcast, or schedule a meeting with one of our advisors.